Good morning, ladies and gentlemen. Welcome to GPI's interim results presentation for the 6 months ended December 2020. The last 6 months have been extremely challenging due to the impact of COVID-19. Not only has the virus affected our business, but the country and the economy as a whole. Many people have lost their lives and their jobs, and our heartfelt condolences go out to those that have been affected. The agenda for today will be as follows. I'll run through the salient features. Jason will then take you through the financial report. I'll then go through a brief operations and strategic overview, followed by closing and a question and answer session. If you wish to answer or ask any questions, please scan the QR code. We'll then collate the questions and respond to them after the presentation. Although the operational businesses resumed normal trade in June, in May and June, the gaming businesses were forced to remain closed and only resumed operations in July under very strict operational protocols. These included restrictions on capacity, a prohibition on the sale of alcohol, and a 9 p.m. curfew. These restrictions had a significant impact on the performance of the gaming businesses, which in turn affected GPI's results for the last 6 months. Looking at the salient features, revenue increased by 700,000. This due to the phenomenal performance and recovery of Burger King, which improved to normal revenue over the period. EBITDA decreased by 36.4 million, headline earnings decreased by 48.3 million, and headline earnings per share decreased by 11.3 cents. Despite the challenging trading conditions, we still managed to decrease debt by 21 million and improved our cash position by 34 million rand over the period. I'll now hand over to Jason to take you through the financial results.
Thank you, Muhsin. Good morning, everyone. During the current and prior period, IFRS 16 has been consistently applied, and therefore these results are comparable on a year-on-year basis. In terms of IFRS 16, rentals are removed from above EBITDA, and the effect is now reflected in depreciation and finance cost. Looking at the statement of comprehensive income, revenue is slightly up on prior period and is broken down in a later slide. EBITDA is down 48% year-on-year. This is driven by lower margins on all operational businesses and equity accounted earnings being down 53%. And this was offset by the impairment of 38.6 million of goodwill relating to Mac Brothers in the prior year. The profit on sale of investment relates to the disposal of N1 City during the 6 months, whilst the impairment of PPE relates to the BKSA stores closed during the period. This resulted in a loss of 1.9 million compared to a profit of 6.5 million in the prior period. Looking at a breakdown of revenue, Burger King is up 5.6% year-on-year, with same-store sales being up 1.7% in a very tough trading environment. Meat plant revenue is up 6% on prior year, in line with the increase in Burger King sales. Mac Brothers were hardest hit, with revenue being down 37% due to the unfavorable trading conditions and the catering industry pulling back all capex spend. Dividends are down as a result of the postponement of all dividends by Spur due to cash preservation measures implemented. Just looking at an EBITDA analysis, Burger King shows a decrease in EBITDA, which is due to its shift in sales mix to more home delivery and increased food costs leading to lower margins. Grand Foods meat plant contributed a negative EBITDA for the period due to increased food costs. Mac Brothers, despite the revenue decrease and margin pressures, contributed a positive EBITDA of 0.5 million as a result of cost-saving measures implemented. Other, it includes head office cost and the investment in Spur. This is higher than the prior year by 6 million due to the postponed Spur dividend mentioned earlier. Just looking at a breakdown of equity accounted earnings, Sun West and Sun Slots were negatively affected by the national curfew and alcohol sales restrictions, with Table Bay only opening during November 2020. This resulted in equity accounted earnings being down 38 million year-on-year. A breakdown of their performance is provided by Muhsin later on. Looking at analysis of headline loss and each investment's contribution, this shows a loss of 4.2 million, which is 48 million lower than the profit in the prior period. Burger King's contribution to the headline loss amounted to 4.1 million. This is down from a profit of 7.8 million, and it's largely driven by the decreased margins. Mac Brothers, despite disappointing sales numbers, have managed to pull back their loss in a very tough environment from 9.3 million in the prior period to 5.5 million in the current period. Due to the delay in the Spur dividends, its contribution decreased by 7.2 million. Gaming and leisure's contribution declined by 37.7 million. Central costs came in flat year on year, and finance charges are down 31% due to the reduction of debt in the last 6 months. Just looking at the statement of financial position, GPI remains in a very healthy net asset position of 1.68 billion and meets the solvency requirements. The debt and cash will be discussed in the following slides. Looking at a term debt analysis, during the period, GPI reduced its debt by 21.9 million, bringing its debt equity ratio down to 11.2%. The debt EBITDA ratio decreased to 3.11 times due to the decline in the EBITDA. This, however, is still below the target of 4 times. GPI's cash position has improved from an opening balance of 21 million to a closing balance of 54 million. This is made up of cash balances of 142 million, offset by overdrafts utilized of 88 million. During the year, the businesses generated positive cash of 79.9 million. No rentals are included in this figure, as this is shown under leases repaid and finance cost and amounts to 33.7 million. Very encouragingly, Sun Slots resumed paying dividends, and GPI's portion was 24 million. Proceeds from the sale of N1 City amounting to 26 million were also received during this period. Management and the board have evaluated GPI's cash requirements for the next year and have analyzed various scenarios, and is comfortable that the group has sufficient cash and borrowings available to satisfy the liquidity requirements of the business. I would just like to extend my thanks to the whole GPI team for their continued efforts during these difficult times. I thank you for your time, and we'll take questions at the end. I'll now hand you back to Mohsin.
Thanks, Jason. This slide outlines our strategic initiatives over the last 6 months and how we've tracked against these. Under the sale of non-core assets to reduce debt, over the period we've concluded the sale of N1 City for 26 million rand and accepted an offer on number 3 Epping for 6 million rand. The latter was concluded in January and is not included in the interim results. We've reduced debt over the period by 22 million rand. Maximize value through a controlled sale of assets. In February this year, we concluded a share purchase agreement to sell Burger King South Africa and Grand Foods Meat Plant. These transactions are anticipated to close in June 2021 and will unlock in excess of R1.15 in value. Over the period, head office costs remain flat, but we are investigating ways of reducing head office costs even further. One of our major areas of focus has been to improve the profitability of Mac Brothers. Over the period, we've implemented an aggressive restructure of the business, which resulted in a 41% improvement in earnings contribution. Looking at equity accounted investments, these include our investments in gaming. These businesses were severely affected by COVID-19 and the related lockdown restrictions. Sun Slots was the star performer of these businesses, and despite the extremely challenging conditions, managed to recover to normal levels towards the end of the period. The recovery, however, was halted with the reintroduction of level 3 restrictions towards the end of the year. Over the period, revenue was only down 15%, EBITDA was down 18%, while net profit after tax was also down 18%. The business is in a healthy cash position, and it's encouraging to note that the business has resumed dividend payments. Dividends for the period increased from 30 million to 80 million over the current period. SunWest and Worcester, on the other hand, were slow to recover. SunWest was down 53%, revenue was down 53%, while EBITDA was down 62%. Worcester's revenue was down 34%, while EBITDA was down 60% over the period. Burger King showed remarkable resilience, recovering to normal levels over the period. Total revenue for the period increased by 7% from 630 million to 676 million over the period. Comparative monthly sales, shown in the slide, were for the most part of the period up on prior year, with comparative sales for the 6 months ending 1.7% higher than the prior period. Despite the strong revenue growth, profitability in the business was under pressure. Burger King realized an EBITDA, and this is pre-IFRS 16, so includes leasing costs, EBITDA of 33.14 million, which is 35% down from 50.9 million in the prior period. The decline is attributed to a decrease in gross margins due to a sales mix shift towards home delivery, which increased from 5.6% of sales to 16.3% of sales in the current period. In addition, food cost inflation, driven predominantly by an increase in the beef price, played a significant role in decreasing margins in the business. Mac Brothers was affected by the decline in the hospitality and restaurant industries, which was severely affected by COVID-19. Many of the businesses in these industries canceled or delayed capex spend, which affected the business. Management focused on driving revenue through the hospital industry while restructuring the business to improve operational expenditure. Over the period, revenue decreased by 28% from 95.4 million to 68.5 million. Despite the decrease in revenue, EBITDA improved by 4 million from a loss of 8.3 million to a loss of 4.2 million over the period. Again, these numbers are pre-IFRS 16 adjustments, so it includes the leasing costs. The major driver being an 8 million rand savings in operational expenditure realized through the restructure of the business. The savings, permanent savings, are expected to continue over the next 6 months. Over the next year, our focus is to continue to improve the profitability of the business while investigating a possible exit. The last slide summarizes the way forward for GPI. Our primary objective at GPI is to unlock value for all shareholders. Over the last year, our strategy to unlock value through a controlled sale of assets has had some minor setbacks, which we've managed to overcome. We are still committed to unlocking value and are tracking in line with our initial plan. Over the next 3 months, we expect the sale of Burger King South Africa and Grand Foods meat plant to close, which will unlock in excess of R1.15 in value for shareholders. Although the deal on the head office building has lapsed, we have received a fair amount of interest in the building, and we are confident that we can conclude a deal over the next year. Mac Brothers continues to be a major area of focus for the management team. We will build on our efforts to improve profitability of the business and look at exiting the business at the right time. Over the last few years, we've drastically reduced head office costs, and we will continue to look at ways of reducing head office costs in the business. The sale of the head office building will improve efficiency and allow us to reduce costs further. Lastly, once we've concluded the sale of assets, we'll reduce debt and look at returning capital to shareholders. In closing, I would like to thank the GPI board, the management team, the executive team for their support. The last year has been extremely challenging, and the team has done an incredible job in navigating the business through troubled waters. We are now well positioned to deliver on our primary objective, which is to unlock value for shareholders. I thank you all. I'll now recess for a couple of minutes to collate the questions, and then we'll respond to those questions. Hi, everybody. So just running through the questions. The first question's from Paul Whitburn at Rosendal. How long will it take to roll out the additional 500 LPM machines and to do the Type B sites? Still need to be built. Um, sorry, I'm just struggling to read this. And yeah, will these impact Grand West? So just on that, we've rolled out 100 sites in the Western Cape. I think there's 400 left. It'll probably take us 3 to 4 years to roll out the remaining. And I don't think that these will affect Grand West. I think it's a completely different market. Grand West is dependent on the high rollers for their revenue, whereas this is a much lower level. So I don't anticipate any impact on Grand West. The next question, SunSlot's dividend was 80 million from 30 million. What's the sustainable dividend from slots in the medium term? Yeah, I think the sustainable level is probably about 100 million a year in dividends. The next question, I think related to the previous one from Dirk at Kagiso. What is the scope for increased dividends from slots given the large cash balance? Will dividends exceed operating cash flows going forward? I don't think that the dividends will exceed the operating cash. And yeah, like I said, that sustainable dividend is around about 100 million, provided that the business continues to perform it as it has. Then the last question from Mark Naramore at Excelsior. In what form will the Burger King proceeds flow back to shareholders? So as mentioned, I mean, the exact details will still be discussed once the proceeds flow, but our intention is to partially pay down debt, and then the rest will be returned to shareholders. Yeah, any other questions? Okay, well, so that's it. I don't think that there's any other questions. I thank you all for your time, and yeah, we'll catch up on our one-on-one sessions. Thank you very much. Cheers, bye.